Hello, everyone, and welcome. Thank you for joining our webinar. My name is Sarah Lanz, and I'm the Marketing Director with Kat Dabosh. I will be helping to facilitate the beginning and the question portion of our presentation. Today, our professionals will discuss and provide guidance around how to prepare WIP for a smooth year-end. But before we get into that important topic, I just have some general information to share. If at any point throughout the presentation you have questions, please feel free to submit them in the questions section of your control panel. We will save time at the end of our presentation to answer them. A copy of today's slide is in the handout section for your use. We will also be providing a recording of this presentation to all attendees after the seminar, along with another copy of the slides. Yes, one CPE credit will be given to all attendees who stay and participate for the full duration of the presentation. The credit will be sent by a Kat Dabosh HR representative in the next few business days. Today's presentation has some large graphics that we notice slows the slide transitions down a little bit. Our speakers are aware of it and will adjust their discussion for the best experience possible. So now I'd like to go ahead and get started by introducing our speakers. Claudia and Kristen are leaders within Kat Dabosh's Accounting and Advisory Group. In their roles, they are dedicated to assisting contractors with personalized and attentive service and strong technical expertise. They are both valued advisors on diverse construction projects, providing expertise on improving job performance and enhancing profitability. And they also provide thought leadership on various accounting and auditing matters as conference speakers and contributors to numerous industry outlets. So let me turn it over now to Kristen.
Thanks, Sarah, and thanks to all of you guys for attending our webinar today. And hopefully this hour will save you a few headaches at year end and make your life a little bit easier. So today we're going to go over, the first thing I'm going to do is get everybody on the same page. I'm going to go over some job schedule basics. Now we're going to talk about what we do as CPAs when you, a contractor, send your WIP or job schedule over for your auditor review. How do we look at it? How do we analyze it? And why are we asking you these questions? Then we're going to go over the impact that revenue recognition had on our contractors and what we've been seeing related to revenue recognition. And then we have a couple of tips for an efficient year-end close. So the very first thing we do when you send over your WIP schedule and your trial balance or your internal financial statements is we do what we call tying out the job schedule. We make sure that your job schedule ties to last year's job schedule and to your internally prepared financial statements. Because if it doesn't, we don't know that it's a reliable source of data about the company. Like what's missing, is something incorrectly reported. So we do what's called tying it out. The very first thing we do is we tie out over under billings. So here we have a snip of the job schedule, and we see our under billings tie here to our assets, and our over billings tie here to the liabilities. Now these should tie, I don't say down to the penny, but down to the dollar. So the next thing we'll do is tie out our prior year job schedule. I like to think that the job schedule has three parts. You have your contracted date, you have your prior year, and then you have your current year. And current year is just your contracted date less whatever you picked up in prior years. So if your prior year isn't right, your current year can't be right. So the next thing I do is I tie out the prior year. Now in this example, we're only using a closed job schedule. So it's likely that you will have prior year amounts on your open job schedule as well. But for simplicity, I just use the closed job schedule. So down here, we have our prior year cost and gross profit and revenue. Now these should tie to last year's open job schedule. This ensures that one, all of your open jobs from last year are on your job schedule, and two, that these amounts are correct. And if these amounts are correct, then these amounts will be correct. So once we tie in our prior year, we know that we can then tie in our current year. So when we tie in our current year, in this example, we're tying in our open and closed job schedule separately. So up at top, we have our open job schedule, and you can see our last three columns are our current year columns. So current year revenue, cost, and gross profit tie down here to our summary. Then next we have our closed job schedule. Same thing, here's our current year columns, So here we're just subtotaling. And then from here, we take our totals, and you can see in this example, they tie out perfectly to our income statement. Now we know this doesn't always happen, right? There are costs on jobs that were closed last year. They're going to be missing on your job schedule. Maybe you have a large service division and you don't include those. Maybe you have some T&M work. You know, maybe you did your friend a favor and there's like a tiny bit of cost related to that. You know, so we know that these things will not tie out exactly all the time. But if you're struggling to tie it out, maybe just call your CPA and say, hey, I'm off by $25,000. You know, what should I do? And they might say, oh, that's immaterial to the statements as a whole. We're not going to even worry about it. Or they might say, that is material, and here's some places you can go to help, you know, find your difference. Accrued losses are tricky, so we did want to spend a minute or two talking about those. There are a couple of different ways you can report it. So GAAP says when you know you're going to have a loss on a job, you need to pick up 100% of that loss in the year you know you're going to have a loss. So you don't pick up your gross profit times your percent complete. You pick up 100% of your gross profit. So in line 1 here, this is not correct at all. 100% of the loss is not recognized. You can see our estimated loss is $350,000, but we've only picked up $311,000. And since here's the result of that, we have an overbilling of $411,000. Now, if the loss isn't material, a lot of times we see contractors run it through their over/under billings. This is not technically correct, but if it's not material to the financial statements, we are fine with this presentation. So in line 2, we are picking up $350,000 of loss, and we've adjusted our overbilling. So you can see this has increased by, I think it's a $32,000 difference between these two. And you can see our earned to date has decreased. So this is not technically correct, but our bottom line is right. Our current liabilities are correct. You know, it's not materially misleading. Now, the 100% technically correct way to show your accrued loss is in line 3. Here we're picking up $350,000 of loss, but here you notice our actual cost to date has increased by the $38,000 of our accrued loss. So we've recorded a journal entry that debits costs incurred and credits accrued loss. So now we have an extra liability of $38,000 on our balance sheet. Our overbilling here is the same as it was in here, and our revenue earned is the same. So this is, you know, the 100% technically correct way to do it. But again, if your loss is not material, you can go ahead and use row 2. Row 3 does get tricky if you have this loss job open for more than 1 year, because then your costs incurred to date for the following year, you have to subtract what you accrued last year and add your current accrual, so it can get a little tricky. So if you're struggling with that, again, you know, before you send over your job schedule, just call your CPA and have a quick conversation about your accrued losses. Overhead is another tricky concept that we do talk to our contractors a lot about. Overhead is just a pool of costs that are related to your job, but you can't directly allocate the way you can materials, subcontractors, and wages. So it includes, you know, like if you have a shop, auto repairs, health insurance, workers' comp insurance, and sometimes estimators. The trickiest thing about overhead is that there's no one way to do it, and every contractor can do it a different way and have it still be correct. So we have some contractors that have a lot of equipment, so they have an equipment pool and a labor pool, and they allocate their labor based on labor hours or dollars, and their equipment based on equipment hours. We have some contractors that don't have a lot of equipment, so they only have like a labor pool, and they will put their auto repairs in their labor pool and allocate it based on labor hours. So, also, estimators, some contractors say estimators are sales costs and expense it as G&A, and others say estimators are an indirect cost and included in their overhead. So you can see it's a gray area, but mainly what we're looking for is that you did capture all of your overhead costs and that they are applied to your job in a reasonable method, and that you're doing it. So All right, Claudia, can you tell us about analyzing the job schedule?
Okay, so Christy showed you the job schedules. Now we're going to go through what we do when we get the job schedules and how we analyze them. So cost to complete is an estimate. We all know it's an estimate, but it drives how much revenue is recorded. So let's say you have $900,000 of job costs on a job, and you're estimating a total of $1 million on that job. You have $100,000 of cost to complete. You're going to pick up 90% of that revenue. However, let's say you miss the mark, you end up having $300,000 of additional costs of $1.2 million. You should be picking up 75% of your revenue, but you've picked up 90. So that's, we're picking up a lot more revenue than what we should be. And what happens is in the following year, we end up with profit fade. So we try to avoid having profit fade and getting those estimates more right on target. So we analyze the job schedule in several different ways to try to determine that our estimates are appropriate. And that gives us a comfort level, and we can document our files and also help advise you if we think there's some things that may not be correct. So some of the most common issues that we find with job cost schedules are with the incorrect contract price. It can be missing change orders. It can be duplicate change orders. Some people aren't necessarily keeping everything in their system. They're keeping off, out of system Excel sheets with job cost information, and those are subject to a lot of potential issues. So there could be problems with the contract price. The incorrect bill to date, same thing there if somebody's keeping it out of system, or maybe there's some things that were charged to the wrong job, but we want to make sure we get the bill to date correct. I've also seen bill to date in excess of the contract price because the bill to date has change orders in it and the contract price is missing the change orders. The cost to complete, under overstated, as we talked about, they're an estimate. So you need to look at that every time that you have, that you're reporting. A lot of times, okay, here's our estimate, and people go with what they think their estimate is and never update it, and it changes as the job progresses, so you need to make sure that that's a proper number. Incorrect overhead allocation, Chrissy just talked about that. There might be over or under applied overhead in some year in some cases, and sometimes we'll break that out separately on your financial statements. Let's say 2020 might be a good example of you have this overhead pool, you had equipment sitting idle. In that case, people might have had under applied overhead because they didn't, they weren't utilizing all that they normally would. And then incorrect cost to date, things get charged to the wrong job, or, having off, out of system job cost schedules can also mess with that. So one of the things we do is we look at the gross profit overall. So we like to see, this is the ideal case because this is our example contractor. Gross profit on jobs in progress are 19%. Gross profit on completed jobs are at 19%. Overall is 19%. And this is, the perfect world. What we don't like to see is contracts in progress having, 20% and completed contracts having 5 or 10%, because that means your estimates may not be right. Now, there might be a plausible reason for that, but that is something that we definitely look at. And when we have the more gross profit that's from jobs in progress, in this case, 46% of the gross profits from jobs in progress, the more likelihood we have of, issues because there's more estimates. So if you only get 10% of your gross profit from jobs in process, maybe we don't have as much concern about that. So this is like the detail behind the previous slide. So we put this in our files. We try to do some trend analysis. Sometimes we compare to the prior year. Sometimes, we'll compare to the prior 3 years. And, this is a good example because, the last 2 years haven't really been what we've been used to with COVID and things, getting a little different than what they previously were. So in this case, we always like to look at the jobs in progress compared to the financial statement. So the top part is just the jobs in progress at the end of the year, and the second section there is your overall on your financial statement. So you can see in 2019, we were at a 19.5% gross profit. In 2022, we're at 19.64. But the 2 years in between, we were lower. and we were lower on our jobs in process than what we were on overall from financial statements. And that's because in this case, we were estimating that we were going to have additional COVID costs running, and we didn't know what our estimations were going to be in the future. There was a lot of uncertainty, so we were budgeting, assuming that there may be additional costs. So now, things were more status quo and we're back, closer to the norm. So we'll compare those, and then we look at things that are, out of threshold and try to determine why they are out of threshold. So then we look at individual jobs gross profit. It can be compared to a lot of different things. Typically, on an average contractor, we'll look at it compared to the financial statement overall. That's the easiest number for us to obtain. But if you have divisions or departments, you really want to compare to that, because you might have one division where you have an 8% gross profit, and you could have another division that has a 25% gross profit. So you really, it doesn't really make sense for us to be comparing, 8% gross profit jobs and 25% gross profit jobs to an overall 13% on the financial statement, because everything's going to be out of scope at that point. So we need to find the most appropriate thing to compare to. It could be budget. If you have jobs that are going on for years, you might be bidding jobs at 20% right now because you can't get labor, and materials are expensive, and you don't know what's going to happen in the materials market, but you might have been bidding them 10% 2 years ago because you're like, we need work, we need to keep people busy, we're worried about what's going to happen with this uncertainty. So if you have that budgeted amount that you bid your job at, we compare this to bid rate as well. So there's no one thing. And we don't do this for every job. Obviously, that would be way too onerous. So what we do is we pick a threshold. In this case, we use 2% of total job costs for the year, and we looked at any job that had greater than 2% of our total job costs and analyzed those. And then we go through and just try to determine what the reason behind the differences are. Profit fade gain. A lot of information on the slide. You can look at it when you get if you have the handouts, it's probably easier to look at here. But the general idea is we look at where the job stands now, and assuming what we know now, assuming we knew that last year, what would the job have looked like, assuming what we know now? So we look at this from both a dollar perspective, and we look at it from a percentage perspective. So we try to look at out of scope on both of those, because sometimes you might have a job that changes 25%, but it's only $5,000, so it's not material in any way. Whereas you could have a job that changes $100,000 or $150,000, but it's only 2%, and because it's just a really large job, and obviously there's more estimation in there, so you're more likely to have a bigger dollar change. So we like to look at both of those criteria before we start asking questions about why these jobs changed. And then under overbillings. Underbillings are obviously much more risky than overbillings. Underbillings, we're picking up additional revenue. In theory, you should be billing in line with your costs that you've incurred. So if you've incurred 70% of your costs, in theory, you should be billing about 70%. We'd like to see overbills, as I'm sure you do, because cash is king. Get the cash in the door earlier if you can. We're not as concerned about those. So we have a higher threshold when we look at overbillings. A lot of times we pick 15%, that's not necessarily set in stone, but we also want to make sure, if you're 40% overbilled, is there another problem in that job cost schedule where we're missing something? So we will still inquire about that, but we're not as concerned about the overbilling. The underbillings, however, are a bigger concern because you're picking up additional revenue. So why, typically a lot of times they might have the cost to complete aren't correct, because if you're going to increase your cost to complete, you're then going to decrease your percentage complete on the job, and it'll be more in line with your billing percentage. Well, a lot of times we'll use 5% for that number and say that's an adequate threshold. And again, it depends on the size of the job. So actually a couple years ago, we had an issue, and we had a huge job, $28 million job on a client, and it had a $1.1 million underbilling. And it was less than 5%, but I put the auditor hat on, and this client only had a $2 million income, which ended up with a loss by the time we were done because there were various things wrong in the financial statements. But the underbilling really wasn't valid. So we said, okay, how do we change this to make sure that we recognize underbillings maybe that aren't 5%. So that's when we put in like our 1% revenue, because we said, okay, if this is material to the financial statement and not just material to the job, we need to look at what's material to the financial statements, because this job had been around for a couple years too, and it was obvious it wasn't progressing at this point. We just had this big underbilling. So that's what we typically look at. So some other things to consider when looking at job costs and how analyzing. We look at costs and the post-balance sheet period, especially on audits, to ensure that they're not in excess of the estimated cost to complete. So, completed jobs that have a lot of costs in the subsequent periods. But you also have to take into account post-period and change orders, because maybe, we have $300,000 of cost to complete, and all of a sudden we end up with $500,000 of cost in January, but there was an $800,000 change order. Okay, that makes sense. In addition to that, you have to consider billings and costs in the post-balance sheet period on jobs that are significantly underbilled. We want to see if the underbilling reverses, and I'll see that in the work paper sometime. There's a $500,000 underbilling. Somebody writes, oh, they billed $450,000 in January. I said, okay, well, what were their costs in January? Oh, their costs were $400,000. Like, well, your underbilling didn't reverse then. And it's great that they billed that much in January, but they had that much in cost. So you're still underbilled in January. So you have to look at both of those. And then consider impacts of change orders signed after the end. If that work was already done, maybe it's in there as a pending change order. Make sure your pending amount lines up with what was actually signed. Maybe it's not in there at all. Make sure it gets in there. So just considering that when looking at your costs as well.
Thanks. Yeah. And to piggyback on what Claudia said, if you have a large underbilling, don't wait for us to ask, what did you bill in January and February, and what were your costs? You can go ahead and stick that in a note, or if you want to add a column on your job schedule, but somehow, you can preemptively communicate that to us that, yes, we know we have this big underbilling, but it did reverse, and here's our costs and billing.
Absolutely. Good point.
All right, revenue recognition. When this originally came out, I didn't think it was going to have a large impact on our contractors because we were already using percentage of completion, but now we've had like 3 or 4 years to sort of look at how this does affect our contractors, and there are a couple of nuances in the new rules that we are seeing impact our contractors. It's variable consideration, which are change orders and unapproved change orders and claims, liquidating damages, incentive bonuses. Sorry, this slide is all variable consideration. These are all variable consideration. I'm just gonna go to the next slide. Okay, so unapproved change orders. This is a hot topic. All contractors have them at the end of the year. Also, revenue recognition is just a timing difference, right? So what revenue recognition does is tries to match our revenue with our costs. And so at the end of the job, right, the gross profit is what it is, and we've picked it up over 2 or 3 years. And so revenue recognition tries to make sure that we're picking up the correct revenue in each of those 2 or 3 years the job was open. So if you have jobs that are open and closed during the end of, open and closed in 1 year, unless you're doing internal financial statements for a bank or a bonding company, you don't have to worry so much about adjusting your jobs on the job schedule for some of these nuances, because at the end of the, when we do the year-end review, it's going to be correctly reported. And that applies for all of revenue recognition. Okay, so unapproved change orders. Previously, there were 4 different ways you could report an unapproved change order, and a contractor could report all 4 of them, like on 4 different jobs. It was all sort of facts and circumstances, so there's a lot of inconsistencies. And so the changes in the revenue recognition now has come up with one way to report all unapproved change orders and all claims. It's the same way. So you have 2 methods. You have the expected value, and this is the weighted average amount of a range of possibilities. And when contractors were reporting change orders and with gross profit previously under the old method, I think this is what they were doing. They were saying, I submitted a change order for $100,000. I've already incurred all the costs. I know I'm going to get 50. I'll probably get a little bit more. I'm going to put 60,000 in my contract price. So that, they were going through in their head this probability of how much they're going to get. The most likely amount, this is when you have two amounts, normally zero and amount and $500,000, let's say, and you're either going to get zero or 500,000. There's no range of possibilities. So you just pick the one that's most likely. Now, once you've figured out your amount for either of these methods, you then apply what's called constraint. So then you look and you say, I'm only going to pick up what I know will not be reversed in the future. So that's it. Now it's pretty simplified. Okay, that's simplified. Claims use the same method. So you'd use that weighted average method for your claims. Previously, we needed to document that you had a legal basis, that the costs were unforeseen, that you could easily identify those costs related to that claim, and that your claim was objective and verifiable. And if we ever needed to talk to your legal counsel, this is what we discussed. Now, we are still discussing these things with a claim. It's just how we determine the amount to include in your contract value is that weighted average method. We have two examples coming up. Okay, so a claim, here we have the amount, we have our possibilities here, and then we have, what the client thought was the chance that they would get. So we come up to the weighted average, and that is what was included in our contract price.
And your probability should always add up to 100%.
Yes, that's for most likely, so we see this with performance bonuses. You're either going to get $500,000 or you're not. So, if you think it's likely that you'll get $500,000 and that you won't need to reverse it in the future, you can go ahead and pick that up, that variable consideration for $500,000.
That might have been hard to do in 2020. You didn't know when you were going to complete it, but if, we're doing 2021 and you're like, I only got 10% left to complete on this job, I'm definitely going to make it.
Right. Liquidating damages. So this is a change from the way we used to do it. So before, liquidating damages were included in estimated cost to complete. The new rules say you reduce your contract price, which does make sense because in this example, our contract price is $40,000 and our liquidating damages are $40 million and our liquidating damages are $2 million. They're not going to pay you $40 million and have you write them a check for $2 million, right? They're just going to pay you $38 million. So we want to, show that on our job schedule. Now, looking here, you think, no big deal, our estimated gross profit is the same. But where it changes is your percent complete. So you can actually see with the revenue recognition, this is the after, this is the before, this is the after, that you're actually more complete and you're picking up more gross profit. The next thing we're going to do is show how we look at some items for materiality. Because you can initially, we'll get there. So uninstalled material. So this is another big change that came out with revenue recognition. Previously, if the materials were uninstalled, but they were unique to your job site, then they would be included in cost to date, and you would pick up gross profit on them. And if they were not unique, it would be included in inventory. Now we have this concept of transfer of control. So if you've transferred control of that inventory, even if it's uninstalled, you can pick it up as a cost to date. You can't pick up any gross profit. If you haven't transferred control, then it's an inventory. Transfer of control is, a little hard to grasp. So we ask our contractors, does your contract allow for you to bill it? Have you billed it? And if you were to get kicked out or walk off that job site, what happens to those materials? Do you take them or do you leave them? All right, so here's an uninstalled material example. So this contractor had uninstalled materials at the end of the year of $723,000. And I initially thought, this is material to the contractor, we're going to have to make an adjustment. But we found out that control did pass in all three of these situations. So then it became a little less material. So above we have, on the top part of the screen, we calculated our gross profit under sort of the old rules where we included in cost to date and we pick up gross profit because that is how their job schedule was working. They gave it to us this way. The gross profit on this job was 267. So then we put it in our template and we said, if we were to back out our gross profit on those materials, what would it be? And it would be 204,000. And so now I'm only looking at a gross profit difference of $62,000 and a revenue overstatement of $62,000. And that number was not material to the contractor. So we were able to leave their job schedule as is and not propose an adjustment.
And materiality is tricky because every year can be different. If you're sitting with a $25,000 worth of income and you have a $62,000 adjustment, it might be material even if your top line is $50 million. Mm-hmm. So it's not like this year it's not material. It could be material next year.
Yes. All right. So in this example, we have where control was not transferred. So the top is exactly the same as in our previous slide. We have gross profit of $267,000. But control was not transferred, so we can't even include the $723,000 in our cost to date. So here's our revised numbers. So you can see we've overstated revenue by close to $1 million. Our gross profit gross profit overstatement is only $30,000 higher than it was on our previous slide. But because we have such large balance sheet changes, I don't know if we would have been able to argue immateriality if had control not transferred. So here is a snippet of the major line items on the financial statements that were affected. So you can see old RevRec and owner-controlled materials are pretty similar, right? These, we feel like there's not a material difference between these two. But here, the balance sheet, we're missing inventory, overbillings. It's harder to argue this. So.
And it does depend on the gross profit that you have as well, because the bigger the gross profit, the more material it's going to be as well.
Yes. All right, pre-contract costs. So previously, your bond costs would just be included in your cost to date, and you would recognize revenue and gross profit on it, right? So if your only cost on a job at the end of the year was your bond costs, it just sort of ran through like any normal job. Now, under the new RevRec, it says pre-contract costs, which are normally like a bond cost or equipment mobilization, commissions. The rules say you're not actually any more complete that job because you paid your bond, right? Like you still haven't done any work on it. So you can't count it as, you're not more complete. So instead of including in your cost to date, you capitalize them on your balance sheet and then amortize them into your job based on percentage of completion, right? Which seems like a lot of work, especially for like a 1% bond cost. So initially I was like, this is never going to be material for a bond cost, right? Until you get your contractor's trial balance and bond cost has gone up $500,000 over last year and most of their jobs are open. And you're like, oh, I should look at this in a little bit more detail. So in this example, on open jobs, we had bond costs of $385,000, and that was material to this contractor. So our gross profit with our bond cost was about $2 million. So then so this is like old RevRec as the contractor presented their job schedule. So in the bottom part, we pulled out our bond costs and amortized them. And so here, our gross profit, you can see we're talking about a gross profit difference of $25,000. So we were on revenue overstatement of like $300,000, which was not material to this contractor. So we were able to pass on this adjustment as well.
Probably the most likely time where you might have an issue is, let's say you have a small contractor who all of a sudden gets a really big job, and it's December 30th, and they pay their bond costs, and they have this huge bond cost on an otherwise small statement. They haven't made any production. Then it might be something that needs to be adjusted.
Mm-hmm. Okay, so again, if you know that you have a lot of bond costs sitting in your open job schedule, let us know. We can send you this template and you can fill it out and we can make a determination before we even come out and finalize the job schedule, if we need to adjust your job schedule for bond costs. Okay, job combination.
Oh, okay, yeah.
Go ahead.
Okay. So job combination previously was, it was more subjective. We would also often look at things geographically. When Harford County was developed, they were doing retail and residential and commercial, and things were close together. And sometimes we had, truck drivers would go to 3 job sites and things were just all messed up. So we'd say, okay, let's just combine these 3 jobs, because this one obviously doesn't have a 40% gross profit and this one doesn't have a loss of 10%. So we would combine those jobs on the job cost schedule. Now there's more rules around that as well. So the first thing you need to look at is, are the jobs entered at or near the same time? At or near the same time is not defined. We've actually used years to determine at or near the same time, because if we look at the other criteria, we really felt like those jobs were connected, and they must be with the same customer or a related party of the customer. So in the old example, we can't combine the retail and the residential if they're with different customers, because it's just, that's how the rules work. And then after you look at those 2 to see if you meet both of those criteria, then you look at the next 3 criteria, and it's any one of these criteria. So these are ORs. The first 2 are ands, these are ORs. So if the contracts are negotiated as a single bundle or package with a single business objective. So a really good example of this is design-build contracts. Your single business objective is to build a building. It's not to design a building and then build a building. It's to build a building. So originally when RevRec came out, we were talking a lot about design-build contracts. Oh my God, we got to separate design, separate build, because we have different performance obligations. But then as the rules got clarified, we're like, oh great, design-build is just one single objective. If consideration in one project is tied to the price or performance of the other contract. So let's say, somebody's putting up 2 buildings next to each other. You have a contract for building A and you have a contract for building B. You might be bidding those buildings assuming that you're going to get both of them. So are you bidding building A if you were only going to get building A, and bidding building B as if you were only going to get that one? Or are you bidding them differently than you would? So if that contract prices, they're sort of tied to each other. And the promised goods or services in the contracts represent a single performance obligation. That's the other criteria. So here's an example of job combination. There's a job right now where we're showing it. We could be showing it either way on the financial statements, but let's assume somebody's split out example 1 and example 1A. They have these 2 contracts, and we look at them, and the one is 100% complete, but it only has 3% gross profit, and the other one's 61% complete, but it has a 40% gross profit. So we are picking up much different amounts. Under that case, we're picking up $546,000 of earned revenue. If we determine these contracts should be combined, we'd be picking up $573,000 of revenue on this particular contract. So this is another one of these kind of things that we're like, we don't care if it happens during the year and it's open and closed by the end of the year. It's really if you're going over year ends and you have multiple year jobs that it really comes into play. The other time that we don't care nearly as much is if your gross profit's the same. If your gross profit's 31% on one and 30% on the other, you can't be materially different. So as you can see on this one, because our gross profits are so different, it really does impact the numbers. Previously, before 606, contract assets and liabilities didn't exist. Our biggest contract assets and liabilities are your under and over billings and retention receivable. So now what you're supposed to have is one contract asset or liability per contract. So we're going to talk about that per contract. So most of you, I'm sure, have conditional retainage, and conditional retainage, because it's subject to a condition other than the passage of time, it's supposed to be a contract asset and not a receivable anymore. So what you're really supposed to do is offset all of your contract assets and contract liabilities on a contract-by-contract basis and come up with one contract asset or one contract liability. So if you look at that first job on that line there, we have $677,000 of overbillings on a contract with $458,000 of conditional retainage. So assets have $458,000, liabilities have $677,000. Really what we should be showing is in that second to last column, a $219,000 contract liability. So those items are supposed to net, but only net on a contract by contract basis. So it gets a little complicated because you need to look contract by contract. So our asset and our liability overstatement, both of them, are overstated by $458,000. We have not been doing this on our contractors for the most part because we're trying to determine what do the bonding companies want to see. The bonding companies probably want to see all your retention and they want to see the overbillings. We went through peer review last year, and peer review didn't bring this up. We're documenting this in our files, so we're not ignoring the rules. We're recognizing that there is a rule, but then we're saying that we're not following the rule because we think it's more what the user wants to see.
We've also talked to other CPA firms about this, and a lot of them,
it's split.
Yeah, some of them are doing it, and some of them aren't doing it.
Right.
So
it'll be interesting to see what we say 3 years from now because, there might be more guidance that comes out. Sometimes you kind of go toward a best practice or a generally accepted, even though it's not GAAP, it's sort of generally accepted. I'm not advancing. Okay. Okay. So some tips for year-end close. Start in the fall during tax planning. We provide our clients and keep in our files a revenue recognition checklist. So go through that. I know it was completed a couple years ago, but things change. You may not have had uninstalled materials in previous years, but now you're like, oh my God, supply chain issues. I've got to stock up on stuff. So you're trying to buy things in advance. So there are things that change, or, bonded jobs, whether you have a big bond at the end of the year. So that is something we'll want to look at every year. What types of adjustments have been made in the past? What work papers, could you possibly help us out with? Anything that you can do will definitely help things run more smoothly and we'll be able to turn things around more quickly. Reviewing overhead calculations and applications. Your overhead rate should be calculated on an annual basis. It's really that year because overhead can be vastly different between years, depending on how much you're producing and various factors. So review those and make sure that you're applying the correct amount of overhead to your jobs. Being ready when scheduled and communicating ahead of time if you anticipate a delay. We're just like you, we're trying to schedule our jobs, and especially during busy season, if you're not ready, we can't just bump everybody because, a particular client's not ready. We can't bump everybody back a week. So we've, got to shuffle you to the end of the line or, whatever we can, but the earlier we know, the more we can do to try to make things run more smoothly. Start uploading information because, maybe the job the week before you has a little bit of downtime and somebody can start, putting things in the file and uploading trial balances and that kind of stuff. So that will also help us to deliver more timely and make things go more smoothly for you as well. Being prepared for questions. We talked about our analytic templates. There are certain clients we give our analytic templates to, and we'd be happy to give them to more of you. And the revenue recognition templates, which are the ones Christy was talking about with, analyzing things that 606 changed. Getting ready for the footnote preparation, debt and lease schedules. And leasing, if you're not aware, is changes this year unless you have a GAAP departure. So we will need the information related to that. And debt, we have our 5-year maturities and a whole bunch of footnotes around debt. Backlog footnotes, if you have a bunch of jobs that aren't going to get started until 2023, you can start to put that backlog schedule together now. Obviously, the backlog for jobs in process comes right off of your cost and profit schedule, but for those jobs that are out a little further, you can make a schedule for that. Related party transactions, a lot of contractors have a lot of related parties, and there's a lot of disclosures around that. So we need balances and transactions and relationships. Maybe you have new related parties. We'll need that information as well. Receivable information for open versus closed jobs is generally accepted. It's not required under GAAP, but it is something that the AICPA said is good for construction contractors, so we try to put that in there if we have that information. And just to try to make things go more easily and more smoothly, don't buy excess inventory before the end of the year, if you can avoid it. You know, sometimes clients will call us up and say, hey, I was getting ready to make a distribution or do this or do that before the end of the year. Should I do it now or should I wait? So, you know, if it's not going to impact you, wait until next year, and then that way we don't have adjustments that we have to make to your cost and profit schedule and your financial statements. Make sure your billings are current. You know, a lot of times there's these small jobs. You know, I'm typically doing, you know, $600,000, $1 million jobs, and all of a sudden I'm doing, you know, my neighbors, whatever, for $50,000, and I haven't billed them because it's just not on my radar as much, but try to get all those billings done because receivable is better than an underbilling. Make a push to get change orders signed. Make us the bad guys, you know, we'll play bad cop here. You know, just use that with your customers to try to get this change order signed, which just really helps your financial statements. It gives us more of a comfort level. I'm sure it gives you more of a comfort level as well. And bill any conditional retainage to the extent available. Again, conditional retainage is a contract asset, and a receivable is a better asset when a bonding company or anybody else is looking at your financial statements. So if that job's complete, if everything's been accepted, just bill it as soon as, you know, actually make it a billing as soon as possible. And if possible, delay costs on jobs not started, you know, the bonds and that kind of thing. That'll help simplify things as well. And that's Chrissy and my information. And Sarah, do we have any questions? Please feel free to submit your questions.
I think there's one or two.
Hi. Thank you, guys. There's definitely lots of good tips and best practices. I might have to watch this again for all the good insight you gave us. Yes, if you have any questions, please go ahead and put them in the question portion, and we'll make sure to answer them. It looks like we do have one question. Let me see if I can pull it up here. It says, how does this affect prior year financials and tax returns when projects were initially separated and now under the new accounting rule, they're considered as one job?
We did have some of those when we initially went to revenue recognition, and it kind of depended on how far along that initial job was. In some cases, I think we drew a line in the sand and said, okay, well, whatever was recognized on that job previously, we'll like almost treat that as a completed job, and then we'll combine these going forward. I don't think there's any one way to do it. I think it's sort of facts and circumstances. I don't know, do you have any?
I agree. But from the tax side, I'm actually glad we had this question. It doesn't affect your prior year tax returns at all because that is strictly a financial statement rule. All of the revenue recognition, the uninstalled materials, the pre-contract cost, 100% financial statement only. If you did in fact make a change for uninstalled materials, you have to reverse it and put it back to old revenue recognition for your tax return because the IRS does not allow you to sort of like defer incurring costs because that defers picking up revenue. And actually the IRS says even if you bought inventory materials for a job and it's not installed, you know, like your copper came in and you wrote the job number on it, you just assigned it to that job and you have to pick that up. It's not inventory, it's a job cost. So, yeah, so all of that was financial statement only.
I think this question was related to the one you just answered. Maybe it was construction projects that are phased, where phase contract award year 1 and phase 2 awarded in year 2, phase 3 awarded in year 3. Sorry, these are considered job 1, I believe.
Right, that's typical in the government contracting arena. A lot of times you get an award and they build onto it each year. I'd say that's facts and circumstances as well. It kind of depends on the situation, because a lot of times they're a lot of times we see that in the consulting arena, and we do consider those separate performance obligations because you don't know you're going to get all of those contracts. Whereas in the construction arena, you know, if you're already in there doing certain things, you're most likely the one to be awarded to it, you know, the job. So a lot of times we combine them. So it's back to facts and circumstances and looking at that criteria that we talked about on that one slide.
Great. The other question is, what is the procedure if you do not segregate unapproved CO costs?
Change order costs.
Yeah.
So as far as picking up revenue, I guess, is the question.
And you don't have to segregate unapproved change order costs.
Yeah.
I guess letting us know that there's unapproved change orders and how material they are, and then we may or may not. A lot of it depends on history. If you have a great history of appropriately picking up unapproved change orders, we're not as uptight about it as we would be if you don't have that history. So I wouldn't say there's a one size fits all for that either. We do like to know that that's the case.
Right.
A lot of our clients will give us schedules, and there's pending change orders, and maybe they tell us the status of it and where it stands within its approval process.
Yeah, and again, you don't have to have your unapproved change order costs down to the penny, right? Because I have approximately $100,000 of unapproved change order costs in there. Like, that's why my gross profit is so low, because I don't have the change order in my revenue. I've got these $100,000 in there. My gross profit's low, right? And then we can talk about how much of the change order, where are you in that change order process? Did you get a verbal approval? Are you just waiting for a couple of things to be signed?
Are you unapproved to scope, or are you unapproved to cost? There's things related to that. Another thing, in Chrissy's slide that she showed where we went through that probability weighted example, I think in that case, let's say the client had like $750,000 of unapproved change orders in the schedule. I think that slide had $800 and some thousand of change orders if we went through the probability weighting. We just left it at the $750,000 because all we're trying to do is get a comfort level that we haven't overstated revenue and that we haven't overstated the unapproved change orders. So it's not, we don't care about tying them out to the penny. We just want to make sure we're within a reasonable range.
Mm-hmm. Right. We're looking at these job schedules because as reviewers or auditors, we are issuing assurance with the financial statements. For a review, we're saying these statements aren't materially misleading. Right, so that's what we're trying to do, is to make sure your job schedule is materially correct and there's no large errors on it. So.
Makes sense. Another question is, any new or recent information on tax items to do prior to 12/31/2022, such as large equipment, additional material costs to have on site in charge to this year as opposed to next year?
So just a little plug for Kristen's Construction Corner. We do have a short video about year-end planning. So just real quickly, bonus depreciation is going away. It's not going away. It's starting to phase out in 2023. So if you are equipment intensive and do have some equipment needs, you want to assess them before the end of the year and get those assets placed in service before the end of the year. If you have R&D, there's a significant change for R&D, so definitely contact your CPA about that. But as far as getting materials installed before the end of the year, a lot of that just depends on your tax accounting method. So are you cash, are you percentage completion, are you completed contract? That's too general. We can't answer that. So.
Going back to available resources, such as Kristen's Construction Corner, you can find all of those topics and videos under the Cathay Bosch website under our Thought Leadership category. Just search by Construction Services. There was a question in regards to, you guys mentioned templates would be available. How should they go about receiving those templates? What's the best?
So you can definitely reach out to your Cathay Bosch representative, and you can either get all of them or just the ones that you want.
We use our dashboard site for most of our clients, mm-hmm. So we can upload, our templates on there, and you can then complete those for us.
We can give you our analytics template. We can give you our RevRec template. I would definitely say if you have some of those rev rec items that we talked about to, get the template, and then you guys can make the determination if it's material or not, and, let us know. So that way you guys just have a little more control over your job schedule. So.
Well, I think that's it for all our questions today. I greatly appreciate your time, and thank you to everyone on the call today. And hopefully you did pick up some good, refreshing points to help you have a smooth year end. And again, our professionals are always available. Their email and contact information will be sent out along with this recording. And again, feel free to check out katdebash.com for any more resources and information on this topic as well. With that, thank you, ladies, and everyone have a great afternoon.
Thank you.
Bye, thank you.